Welcome back to our Cash Value Life Insurance series. Today we are talking about Universal Life, which is by far the easiest and most simple form of cash value life insurance that we're going to talk about in this series. If you haven't already done so, please watch the intro video to this entire series. It's only 5 minutes long. You can see that link above. And it just kind of sets the stage for exactly how we're evaluating all these different forms of cash value life insurance. We've already talked about variable universal life. We've also talked about indexed universal life. So there's a few concepts from those policies that I want to also bring over into this universal life insurance discussion. So number one, all these universal life insurance contracts are going to base their cost of insurance, we'll call it COI here, on what's called the net amount at risk. And if you remember from our other videos, the net amount at risk is a real simple formula. It's just your death benefit minus your cash value. That equals your net amount at risk. And that's the amount of insurance that you're actually buying every single year, which is why it determines your cost of insurance. So as your cash value increases, your net amount at risk should decrease, which means your COI charges are going to do something like this. It's not a straight line up, it's not a straight line down, it's not flat, it moves. It's up, it's down, it's sideways. You reach corridor at some point and then it levels out. Now, what's really cool about Universal Life is that you really only have one option when it comes to building cash inside a traditional universal life insurance contract, and that's just simply a fixed rate of return. So every single year, the company is going to propose a new fixed rate. And right now, those fixed rates are anywhere between 3.5% and say 5.25%. Now, this fixed rate is subject to change every single year because it's based on the current interest rate environment that exists. And typically when we talk about the interest rate environment, what these companies are really looking at is what's called the Moody's corporate bond yield. So the fixed rate that you are offered by the insurance company should loosely track with the Moody's corporate bond yield. If interest rates go up, the insurance carrier should offer you a higher fixed rate. If interest rates go down, the insurance carrier is most likely going to offer you a lower fixed rate. So Universal Life is really simple to understand. There are really not very many moving parts. The upside, as you can see, is not huge. So you might be thinking, well, why would somebody want a universal life insurance contract? If it's simply a fixed rate, it can move. My upside's not nearly as high as an indexed policy or a variable policy. So why would I want an indexed UL contract? Well, the reason that most people look at universal life insurance contracts is because they are primarily protection-focused products. What that means is you're not going to purchase one of these policies if you're looking for maximum cash accumulation. You're going to purchase one of these policies if you're looking for a maximum death benefit and you want the added benefit of some cash accumulation. It's not going to be near as much as the other two policies that we've talked about, but there will be some cash accumulation inside these universal life insurance policies. So we've got protection focused. Let's also add another layer. Most of the time, when you're looking at a universal life insurance contract, you're going to see this being proposed as a limited pay scenario. So you're not paying on this policy for life. A lot of times we see 10, 15, 20, 30-year pay periods. So you're paying for a shortened amount of time, hoping that the death benefit lasts forever. Let's add another layer. A lot of these policies are going to contain things like long-term care riders. And so what you end up with is a universal life insurance contract that's not going to be fully guaranteed. It can be, but most of them are not fully guaranteed. It's going to be focused on protection and maximum death benefit. You're going to pay for a limited amount of years, and a lot of these policies are going to blend in riders for things like long-term care. And since it's a fixed rate of return that's focused on protection, when we go back to our risk reward timeline here, we had VUL at the very far right, most risky, least risky. We had IUL somewhere in here. Universal life is going to be somewhere in here. The reason that universal life is not all the way on the far end of this scale being the least risky is because most of these policies are not fully guaranteed, okay? They can be considered safe, but not fully guaranteed. What that means is, technically speaking, that fixed rate of return that the company offers at the beginning of the year could go to like 0.1%. If interest rates plummet even lower than they are now and even lower than they have been the last 2 to 3 years, if interest rates plummet or if they go negative, for instance, it could be that these policies don't have any fixed rate available. And so then in a scenario like that, you would see a lot of these policies get into trouble. If you have any questions on universal life, you can always reach me at my email, matt@leveragewm.com, or go to our website, leveragewm.com/contact-us. If you haven't done so already, like this video, subscribe to my channel, comment below, let me know what else you want to talk about. I'm about to wrap up this series on cash value life insurance. I know there's so much more that we could talk about, and we could go into much more detail on every single one of these different life insurance policies. But let me know what you want to see. And if you have a policy that you'd like for me to take a look at, again, you can reach me one of these two ways, matt@leveragewm.com, or go to our website, leveragewm.com/contact-us. This has been Matt Decker with Leveraged Wealth Management. Thanks for taking some time with me here, and we will talk to you soon.